meeting that is certainly playing into our session today. Let's bring in Markus Helsing of Alpha Broking, who's joining us live in our Melbourne studio. Markus, great to see. They really do appreciate your time. Now, the market, just talking OPEC, I mean, it seemed to be coming around to the view that we would see some sort of loose agreement. There was so much scepticism given that they've failed so many times before, but they certainly didn't disappoint this time around. Did you think it was a solid agreement?
It looks like one, but obviously the discipline of the OPEC cartel is really the big million-dollar question, and that has always been the case. But I mean, Jonathan Barrett summed it up most beautifully yesterday morning on Sky Business, and I mean, really, they had no other choice. They had to do something. I mentioned that a few times the last few weeks. So essentially, their credibility would have been basically totally gone. Now, we think this is a base builder for the price of oil. It might not yet be a basis for oil to shoot away, because ultimately the S&D, or the supply and demand story, has to be really be shown on the ground, and that will take time. But we think this is a base builder, and this is a tremendous rare opportunity that investors can have. If you look at certain oil stocks that I mentioned many times, the Santos's of this world and Woodside, technically they're looking brilliantly in our view, and they have a lot of potential. So having an agreement like that, even if the discipline is not as much as we'd like it to be, obviously they will have to action it on the ground, and to some degree, especially Saudi Arabia and Russia. And we believe this is a base builder that will probably be responsible for a range in oil that we're now happy to change from your 35 to 55 probably to more like 45 to 65 over the next 3 to 6 months.
Now, we're just going to bring up an interesting chart, Markus. It's around the oil volatility. Now, the white line that we're going to just bring up in a moment is the CBOE Oil ETF VIX Index. The blue line is WTI, the oil price. The oil market volatility, and obviously viewed there by that volatility index, it tumbled the most in data going back 9 years as those prices surged on OPEC's first supply cut accord in 8 years. As we know, those oil prices surged following OPEC's decision to cut that supply for the first time in 8 years. So we are seeing that correlation there, I suppose, the drop in that volatility along with the rise in those oil prices. I mean, what are your thoughts on the oil price from here going forward? Will we continue to see it rallying, and hence that volatility continuing to come down? What are your thoughts going forward?
Well, first of all, it is a commodity, and commodities tend to have bursts of volatility every now and then based on fundamentals, but also based on what some of the hedge funds do with the particular commodities. But you find after bursts of volatility in each commodity, it tends to settle down, like with many other financial markets, into a certain trend, which tends to lower volatility. I would think what happened now with OPEC, that could be definitely a calm effect on volatility on oil prices. It's a bit early to say, but definitely because it has given a certain certainty. I mean, every financial market, and commodities are particularly exposed to that, is certainty. If there is uncertainty, it is very much the base for the volatility in a particular product or commodity. Now we have a certain certainty. You'll find volatility will most likely settle in, and that is sort of stuff that probably makes holders of oil stocks looking forward in a few months' time, looking back to the investment quite happily, because that's the sort of stuff that is really the base for any medium to longer term investment.
Markus, Rudy Philippek van Dijk, F1 Arena. I've missed you, Markus. But anyway...
Well, Rudy,
yes?
Rudy, if I may just interrupt, I will love you look, Rudy. I mean, that's just brilliant.
Very sharp, isn't it?
Thank you, Markus.
It's very tidy.
I'll buy you a beer one day.
You're on.
Markus, observation. The correlation between oil and gold seems to have broken down in recent days, or maybe even recent weeks. And that definitely would have taken quite a few market participants by surprise. Do you think that relationship is going to be reinstated anytime soon, or what are the charts telling you?
A very good question, Rudy, as always. Well, you know, I'm a very long-term bull on gold and silver, as you know, and this US dollar strength doesn't seem to be over. As a matter of fact, it just seemed to have started. So there could be on the dollar index maybe another 7 to 10% in it, which is quite a major move. That in itself will keep precious metals on a back burner because it's simply, in particular with the Federal Reserve coming in with a tightening cycle, makes it a bit less attractive. On the big picture, you know as well as me, major commodities ultimately tend to go in the same directional cyclical move. That can be sometimes, there can be a divergence for 3, 6, sometimes even 9 months. But on a big picture, you find major commodities will tend to move and trend to move in tandem. So if we, for example, would see now an oil pricing heading in trend terms towards $60 or $65 over the next 6 months, for argument's sake, I would expect gold and silver to bottom out over this period and at some point to catch up to some degree. But really, I mean, there's obviously other factors attached to that, and we definitely don't think the US will run away and tighten interest rates like crazy. They might be by this time next year at 0.75 or 1%, but really, if we speak globally at this environment, we speak about very low interest rates. You'll find any time there's a certain crisis popping up, I mean, the stock index is going to extreme high levels and looking as though they might even go higher. So at some point, there's obviously markets are stretched to a limit, and that's when I think many people will look again at gold and silver as a very good alternative, and you probably will catch up with crude oil then.
Markus, it's Adam here from Shaw and Partners. Obviously, you know,
hi, Adam.
Hi. The OPEC decision, obviously, the first time in 8 years. This is fantastic. But do you expect these gains to last due to the fact that the rig count or the US shale production, they can ramp up production pretty quickly? Do you have any colour on the rig count that's going on at the moment in the US?
Well, no, but what I read more about is how much heat all the banks in the US took on all these frackers in the madness of the last 5 years. And I mean, the pain that the banks took, and it's very, very quiet about that, the pain that the write-offs the banks took about all these frackers is massive. So I can't see any bankers, as mad as they might be, to jump back in again at half the force or less. So I think the bottom line is, no matter what business you have, you do need money to operate the show. So there's a lot of fracking that will probably get back online when you see $55, $60 in pricing. But I think it will be a fraction of what you've seen a few years ago. And therefore, I think they will have a delay factor, even with the Trump factor putting in. At the end of the day, you still need banks to finance the show and investors. And many investors and bankers got burned very severely with all that. It will take a bit of time, probably 6 months, 12 months. So therefore, I think you're right. I think oil probably will not run away like that, knowing that fundamental supply side will at some point come on board. But I don't think it will keep oil from not trending higher from here onwards on an ongoing basis with a few hiccups here or there.
Markus, Rudy again. I mean, everyone's always focusing on the extra supply, but what about the demand side? It's probably fair to say that so far this year, the demand side in China has surprised to the upside, but the Chinese have this habit of buying in and refilling their inventories when prices are low. And I've already seen quite some analysts expecting, if prices are trending higher now, that demand from China is probably going to disappoint from here onwards. And that might have the adverse impact that we think, because we're predominantly focused on the supply side.
Look, I mean, that might well be the case, but I mean, you look at the lingo that's coming out of the US in the moment, which with Trump basically embracing a hell of a lot more fracking and back towards the old oil-type philosophy. So that actually might be enough to sort of might get frackers back on board on the one hand, but also might calm people down and get the V8s out of the garage. So I mean, and that's actually what's happening. And what's the biggest success story in the US is the Ford Ranger has been the biggest success story the last 2 years in the US, and that's also a 6- and 8-cylinder guzzler. That's the biggest success over there. So that does tell you a bit the philosophy. They might be a bit different in China, but I think broadly speaking, demand is still rising. And as we can gather, at some point by mid next year, this thing will be, in particular with the cutbacks now, it will be in sort of a balance. It wouldn't need much to tip it over the other side again. But at this point in time, I think there's a bit of a big guesswork going on. We'd probably like to see at least 3 or 6 months of the current production cuts to come come into effect and see the demand side run away. We also have a very, very mild winter, in particular in Europe. And so that all might delay things a bit. But to me, basically, we expect a balance in the oil market by mid-next year.
Markus, let's put all of this together from a share market point of view. How would you be approaching the space from a portfolio perspective? Are you bullish on some of those energy stocks, or do you think that we've missed the boat?
No, I mean, I mentioned that not at all. I think this is just a price and momentum confirmation. We have bottom dwellers like Santos, which is a very geared play to the oil market, which I think is a tremendous buy. Someone who's a bit more conservative, Woodside, technically and fundamentally to us is an absolute must portfolio allocation. If you look overseas, your Exxons or your Royal Dutches, they don't look as attractive. And even here domestically, Oil Search, I think is already much higher price, as it never had as deep a correction as your Santos and your Woodsides. So we think Woodside and Santos are our darlings, to be frank, and we think they're a must-hold.
Mm-hmm. What about, and you mentioned the oil, I beg your pardon, the gold and silver, you know, we're talking there on the back burner, obviously, with that US dollar strength. What about gold and silver stocks? Are you viewing these as sort of a longer-term growth story? Do you think now would be a good entry point, and what stocks in particular are you eyeing?
Well, really, as I mentioned anytime, we basically believe the breakup that we've seen between January and June this year is potentially the beginning of a new bull market in gold. We still have to be proven otherwise, but at this point in time, that is our view. We're committed to it, and we believe this pullback in a moment that's US dollar related, Federal Reserve related, whatever the case may be, it's a bit out of favor at this point in time. So I think anyone who's not positioned yet should be definitely looking at it from here onwards on the physical side. In gold stocks, well, there's obviously international stocks that we like. We do like Barrick Gold a lot, and Gold Corp. There's many others there. Domestically, I mean, Silver Lake is a bit of an offside play that we like. It's a minnow, but nevertheless in production. And Newcrest, because it's the only real big play as an Australian gold stock, has been a bit overloved, and therefore the pricing is already, even after the correction, relatively properly priced. So if you see Newcrest still correcting over the next few weeks or months, I definitely think someone should have that in a portfolio. However, on the opportunity side, I probably would be veering more towards international gold stocks and the smaller ones. Like even if you look at Evolution and all that, I mean, they are in our view already decently priced. So you've got to really look for value, historical value, and we believe the US and Canadian gold stocks probably offer a bit more value there.
Markus, probably worth pointing out that the local producers in the gold sector, they're at this point in time more than ever a currency play on what the Australian dollar does. But equally, when we talk about portfolio composition, it's probably a fair point to say that at this point in time, probably best not to have Qantas or Virgin Airlines in your portfolio.
Mm-hmm.
Well, that's your call.
No, I agree.
Look,
absolutely.
Yeah. Yeah, look, I mean, really, I just think what's happening in the moment is a rebalancing. We had a few shocks this year, and probably the Italians might come up with another one, who knows, this weekend, and the Austrians with their presidential elections. But the bottom line is, I think the Federal Reserve meeting is locked in, the 0.25% tightening, and I really think when you look at the stock markets in a moment, how stretched we are, we wouldn't be surprised to see a major top come up in January, February in these stock indices, or at least a top that's could be pretty much ready for a major correction. So I think all these markets in a moment, people should really be wary. And for gold and silver, I'll just be looking for opportunities to enter long positions.
All right, fantastic. Markus, on that note, we might wrap things up, but it's been wonderful talking to you as always. Do appreciate your time. Thank you.
Thanks, Leanne.